Welcome, everybody. Thank you for tuning in tonight for another episode in our Retirement Masterclass series. My name is Bobby Hapanowicz. I'm your host for the night, and today we're going to be talking about one of the most important decisions for many retirees, and that is Social Security election and some of the strategies that you can consider. We'll break down those strategies and talk a little bit about the importance of factoring the Social Security election decision into your retirement planning. Before we get into the meat of the webinar, just a couple of quick things that we want to run through. We are using SSA.gov figures for this webinar. This webinar is based off of 2023 figures, and those can change from year to year. Another housekeeping item, we want to make sure that you're aware of our YouTube channel. This video is going to be posted to our YouTube channel in the next few days. You can check this out here on our YouTube channel, as well as other master classes and shorter videos on retirement planning strategies there again on our YouTube channel. Just search Hapanowicz and Associates in the YouTube search box. So, many of us are aware that Social Security gets a lot of attention in the media. There seem to be a lot of articles, a lot of discussion around Social Security election relative to other retirement planning strategies, and thought it could be helpful to talk about why that is before we get into the meat of our presentation here today. So why is Social Security election so important? Well, I want to quote the findings of a National Bureau of Economics research study that was just released here in November of 2022, less than a year ago. For Americans aged 45 to 62, the median loss in lifetime discretionary income resulting from suboptimal Social Security election, and the present value is $182,370. And if one optimized Social Security election, one can produce a 10.4% increase in lifetime spending. That's for the typical worker here in America. So there are very few decisions in retirement planning that can have as big of an impact on our income, on our security, and on our lifestyle as Social Security. So with that said, we will start with a brief introduction to Social Security. We'll talk a little bit about Social Security taxes. Then we'll talk about some of the factors to consider when electing your Social Security benefit, when deciding when to elect. And then ultimately, we'll review some Social Security election strategies and case studies. And of course, we'll conclude with your questions. Please feel free to submit questions through the Q&A chat box here, and we'll address as many of those as we can. All right, so let's get started with an introduction. So of course, many of us are aware that we pay taxes to fund the Social Security Trust Fund. So we pay taxes from our ordinary income up to $160,000 a year, and wage income can be taxed for Social Security. And ultimately in retirement, we receive this benefit. The Social Security benefit is known as a primary insurance amount, or PIA benefit, primary insurance amount. The way Social Security works, it's very similar to a pension. It feels the same way as a pension in the sense that you're receiving what financial planners call a guaranteed income from the time of your election through life. Unlike many pensions, Social Security also has a cost of living adjustment associated with it. And that COLA can be applied by the Social Security Administration upwards of annually. Some years have been skipped in the past, but typically there is a COLA, and that allows this benefit to provide the same purchasing power to you in 20 years from now as it does today. So when you think about that, it's a guaranteed income source. There's a cost of living adjustment, essentially an inflation hedge built into Social Security. It's a wonderful benefit and the centerpiece of many Americans' retirement planning. And so how is that PIA calculated? The calculation is pretty complex, but at a high level, the PIA is calculated using the highest 35 years of income that you have had throughout your career. And the standard PIA benefit is elected at full retirement age, your FRA. You'll see FRA throughout this presentation. That's full retirement age. And you can elect a reduced benefit as early as age 62. You can also delay your benefit to as late as age 70 and receive an increased benefit. And so this next slide here shows your full retirement age in the center of the graphic at the top of the screen. It also shows that you can elect a reduced benefit as early as age 62 and an increased benefit as late as age 70. So when is your full retirement age? Well, your full retirement age is dependent on your year of birth. It could be as early as age 65 if you were born in 1937 or earlier. your full retirement age will phase up to age 66. If you're born between 1943 and 1954, your full retirement age will be age 66. Then in years 1955 to 1959, your full retirement age will phase up again until in 1960 and later. If your birth year is in 1960 or later, your full retirement age benefit will be at age 67. So if you elect Social Security prior to your full retirement age, your benefit is reduced on average of 6% per year. If you elect your Social Security benefit after your full retirement age, your benefit is increased by 8% per year up until age 70. There's no benefit to deferring your Social Security election past age 70. Okay, so let's get into Social Security taxes, and let's start with federal taxation. So your Social Security income is taxed based off of what is known as your provisional income. And what is provisional income? It's the summation of your adjusted gross income, your non-taxable interest income, and 50% of your Social Security benefit. So 50% of your Social Security benefit goes into the calculation of your provisional income. And this chart here on the right side of the screen shows how your Social Security benefit could be taxed depending on varying levels of provisional income. If you're married, filing jointly. If you're an other form of taxpayer, we'll focus here on the married filing jointly column. So if your provisional income is $32,000 or less, then your Social Security income is tax-free. Between $32,001 and $44,000 of provisional income will mean that up to 50% of your Social Security income is taxable. And if you have more than $44,000 of provisional income, then up to 85% of your Social Security income is taxable. And the federal Social Security tax rate is 15%. So the maximum amount of tax that you would owe on your Social Security benefit is 15% tax rate on up to 85% of your Social Security income. Okay, at the state level, most states do not tax Social Security income. Many of us here on the webinar today are from Pennsylvania. Pennsylvania does not tax Social Security income. As a matter of fact, Pennsylvania doesn't tax ordinary income from IRA accounts, retirement accounts, if you're older than 59 and a half. We're a retiree-friendly state. There are 13 states that do tax Social Security income, and those are listed on the left-hand side of the screen. The tax rolls, the amount of tax applied to your Social Security benefit will vary from state to state. But if you're from one of these states, or if you're potentially moving to one of these states in retirement, it's certainly important to keep that in mind. Okay, finally, I want to talk about the Social Security earned income penalty. And the earned income penalty may apply to you if you have earned income and have elected your Social Security benefit and are younger than your full retirement age. And this is a very common question that we do get a lot as planners. If somebody is retiring earlier than their full retirement age, wants to elect Social Security, but also wants to work part-time, they want to know how much of that penalty might apply to them. And so there are two ways to determine what that will be. And the first one on the left-hand side is applies to you if you're younger than your full retirement age for the entire year and have elected Social Security early. To put that in plain terms, if your full retirement age is 67 and you turn 67 in 2024, here we are in 2023, you're younger than full retirement age for the entire year. And the earnings limit in 2023 would have been $21,240 per year. And so if you earn more than that, your benefit will be temporarily reduced by $1 for every $2 of earned income over the earnings limit until full retirement age. I just want to point out that says temporary. So you do recuperate the amount that was taken away as an earned income penalty. So, by all means, if you want to work, having that additional income is never a bad thing, even with the earned income penalty present. So let's go through an example of how that would work. In this case, John Smith is 62 years old. He receives a Social Security benefit of $24,000 a year, and he has employment income of $31,240 a year, or income that is $10,000 higher than the earnings limit for 2023. So in this case, John's benefit is reduced by $5,000, or $1 for every $2 of earned income over the earnings limit. Okay, so now on the right-hand side of the screen, these rules would apply to you if you have elected Social Security in the year that you hit full retirement age. So now let's say instead of turning 67 in 2024, you're turning 67 in 2023. These rules would apply to you. The earnings limit in 2023 would have been $56,520 per year. And that earnings limit only applies to the months of income prior to your full retirement age. So if you turn 67 in May, the first 4 months, January, February, March, April, those are the months that the earnings limit would have applied to. And if you do earn more than that earnings limit, your benefit will temporarily be reduced by $1 for every $3 of earned income over the earnings limit. So another example here, Sally Smith is 67 years old in her year of full retirement age. Her Social Security benefit is $30,000 a year. Her employment income is $86,520 per year. And Sally's earnings are $30,000 higher than the earnings limit. So Sally's benefit is reduced by $10,000. Okay, let's move into the next part of our webinar here, and that is factors to consider when electing Social Security. And so I'll start by saying we highly encourage you to make this decision in the broader context of your retirement plan. Social Security election can appear to be a very simple decision. It's not. There are a lot of moving parts and a lot of considerations that you should keep in mind, and we'll show you how some of those work with some of our examples later in the webinar. But if we can distill them down into 3 simple considerations to keep in mind, they are your health, your wealth, and your marital status. And so now we'll look at how all of those play into your decision. So starting with health, you'll want to consider your health history, your current state of health, your family history of longevity to get an estimate of your longevity, because ultimately Social Security in its simplest form, the Social Security election decision is a break-even analysis. The shorter amount of time that you expect to receive your benefit, the sooner you should elect your Social Security benefit. The longer the longevity that you think that you have, the later you should typically delay electing your benefit. Now, I'll share with you the most common mistake we see people make is underestimating their longevity. And I'll share a stat with you from the Society of Actuaries. For a couple who reaches 65 years old, there is a 50% chance that at least one member of that couple will live into their early 90s. And there's a 25% chance of at least one member of that couple living into their late 90s. So as we look at this chart here, this chart is a break-even analysis showing when you would break even if you elected Social Security on different days or at different ages, age 62, age 66, and age 70. And you could see the break even, assuming your full retirement age is age 66, you could see the break even between 62 and 66 is about 78 years old. And the break even between ages 66 and age 70 is 82 and a half years old. But like we said, there's a 50% chance if both you and your spouse will live until age 65, there's a 50% chance that at least one of you will live into your 90s and a 25% chance that at least one of you will live into your late 90s. You could see the advantage of delaying Social Security to the extent that your broader plan allows you to do that, to the extent that it makes sense for you to do so. And so with that, that's a good transition into the next factor to consider, and that's your wealth. And we can measure this through, your cash flow plan, right? We can examine your cash flow needs. What are your expenses today? What are they likely to be in the future? Let's take inventory of your retirement assets and your other retirement income sources. Are IRA or 401k assets present? Is a pension benefit present? Are other guaranteed income sources like, an annuity or perhaps VA disability as another example, are those present? And understanding what your income sources are, what your assets base looks like, can help us determine if you can afford to delay electing your Social Security benefit. Also considering when you plan on retiring. If you're somebody who is planning on retiring several years prior to your planned election date, or perhaps several years prior to the earliest election date that you could possibly have, age 62, that would factor into the decision as well. And then your marital status is an important point to consider as well. So on this slide here, if you're married, there's the potential spousal benefit, and spousal benefits can amount to up to 50% of the spouse's benefit if their benefit is larger. The spousal benefit does not continue to grow past full retirement age, and the spouse with a larger benefit may consider their spouse's longevity in addition to their own when considering their election timing. And that really gets into the survivor benefit. The surviving spouse may inherit the greater of their benefit or their spouse's benefit if their spouse were to pass. And we'll get into more of the details and nuances on how that can work in the election strategies that you can consider here in the next few slides. If you're divorced, you may still be eligible for spousal benefits if you can check all four of these boxes. So if you're married to your ex-spouse for at least 10 years, if you're currently unmarried, you and your ex-spouse are both at least age 62, and you've been divorced for at least 2 years, you can elect your spousal benefits. As a matter of fact, unlike for married couples, your spouse would not have already had to elect their benefit. You can elect your spousal benefit even if your ex-spouse has not yet elected their benefit. For divorcees, you're eligible for a survivor benefit if you've been married again to your ex-spouse. You were married for up to 10 years, 10 plus years. You're unmarried or married after the age of 60, and you yourself are at least age 60 as well. So let's transition into talking about some Social Security election strategies that you may consider to maximize your benefits. And so here we're going to start with a few spousal election strategies. So like we discussed, a spouse may be eligible for up to 50% of their spouse's benefit as a spousal benefit. So in this case, Alex does not have a Social Security benefit. They have not worked long enough to qualify for a Social Security benefit. They have not received enough Social Security credits. Jordan, on the other hand, has a PIA, a primary insurance amount of $2,200 a month. And so you could see here that they both retire at their full retirement age. Alex has to wait until Jordan elects his benefit in order to elect her spousal benefit. She cannot elect before him. They're a married couple. She cannot receive her spousal benefit before Jordan elects his. Okay, let's look at a second scenario here. In this case, Alex's benefit remains $0. Jordan's benefit is $2,200. Primary insurance benefit is $2,200. In this case, Jordan elects early, and because he elects early, he receives a reduced benefit. Alex waits until age 66. And because she waits until age 66, she's still entitled to her full spousal benefit. She is not penalized by Jordan electing Social Security earlier and thus receiving a reduced benefit. Alex is still entitled to her full spousal benefit here because she waits until age 66, or I should say until her full retirement age. Okay, let's look at another scenario here. So this is an interesting scenario because in this case, Jordan waits to collect until age 70, and he is entitled to a larger benefit in that case. However, the couple would have missed out on Alex's spousal benefit, which she could have elected, which did not grow any larger for her past her full retirement age. So the spousal benefit does not grow anymore because Alex waits until after her full retirement age to collect. She cannot collect at full retirement age because Jordan waited until age 70. Thus, she has to wait until age 70. And her benefit, even though Jordan's benefit increases, Alex's benefit does not increase because the spousal benefit does not grow at all if it is deferred past full retirement age. Okay, so wanted to include this slide to show how the spousal benefit works and how it works in conjunction with Alex's benefit. So in this case, Alex now has a PIA of $600, not a PIA of $0 like they did before. And this slide shows how the spousal benefit and the PIA work independently of each other. So the orange bars are Alex's PIA, and the yellow bars are Alex's spousal benefit. And so you can see in the middle bar at age 66, this is Alex's full retirement age. She would receive her PIA of $600. And if she were to retire as early as age 62, she would have a 25% reduction in her benefit. She would also have a 30% reduction in her spousal benefits. So those two work independently of each other. At age 66, she would be entitled to her full spousal benefit, and those work in conjunction with each other. So again, that spousal benefit is $1,100 in this case. It's half of Jordan's PIA. And if she were to wait until age 70, her PIA would increase, but her spousal benefit would only fill up until the maximum level of $1,100 a month. So it wouldn't continue to grow past that point. So in this case, what's important to point out is that there's no benefit to Alex to wait 3 years until age 70, 4 years, I should say, until age 70 to elect her Social Security, or she might as well elect right at age 66 if she had not already done so. Last slide regarding spousal benefits eligibility. So in this case, neither spouse is eligible for spousal benefits. You're eligible for spousal benefits if your benefit is less than 50% of your spouse's. And in this case, both spouses have substantial benefits, and that's not a consideration here. So now we want to run through a couple of different scenarios showing survivor benefits and showing how different election strategies can mean different amounts of income through life. So before we break down the chart below, we'll go through some of the assumptions here. So in this case, Alex's birth year is 1955. She has a PIA of $600 and she lives through age 84. Jordan is also born in 1955, has a PIA of $2,200, and he lives through age 75. So here you could see Jordan elects at age 62, Alex elects at age 62. Alex collects an adjusted spousal benefit of $350. That's a reduced benefit, as is her and Jordan's PIA benefit. And then you could see across the bottom of the chart here, Jordan would receive $277,200 in his benefit. Alex would receive a little more than $75,000 from her benefit and $58,800 from her spousal benefit. She would then inherit Jordan's benefit as a survivor benefit and would receive $196,000. And the total amount earned would be a little more than $600,000 from Social Security and survivor benefits. Okay, now let's consider if the couple were to defer electing Social Security. They lose out on the income in the first between ages 62 and age 66. Relative to the first scenario. However, their benefits are larger as a result. Their monthly benefits are larger as a result. And with their life expectancies, that works out to their benefit here. And you could see that if they both elected at age 62, they would have received $607,000 of income from Social Security. And with them both electing a full retirement age, they're receiving $633,000 in excess of that from Social Security. Okay, now showing if both spouses elect until wait to elect until age 70. And this is an example of how waiting to defer as long as you possibly can is not always the best strategy. And you could see how in this case, even though the monthly income benefit is larger, because of their life expectancies, Alex and Jordan would have received less lifetime income as a result. Okay, finally, this is a strategy that a lot of our clients will use. And this is a strategy in which the spouse with the smaller PIA benefit will elect as early as possible, and the spouse with the greater benefit will at least defer until full retirement age, if not until age 70. And when the spouse with the larger benefit elects, then the spouse with the smaller benefit will also collect a spousal benefit, and that is added on to their income as well. And you could see here how this strategy results in more income for the couple relative to the other strategies. Okay, let's go through another scenario here showing a widow with significant individual benefits. If your spouse predeceases you, you can choose to elect the survivor benefit as early as age 60 and up until full retirement age. That survivor benefit will not grow anymore past full retirement age. And so that's the backdrop to this scenario. But here you can see Chris has a PIA of $2,200. The survivor benefit is $2,500. And Chris lives through age 92. So in this case, Chris elects to take the survivor benefit as early as possible at age 60. And you can see that Chris has a reduced benefit as a result. And Chris elects his Social Security PIA benefit as late as possible, age 70, and thus receives a higher benefit. So you could see here at age 70, Chris's PIA is now $2,904, which is more than the survivor benefit of $2,500. Remember, the survivor benefit does not grow larger if deferred past full retirement age. So because of this, Chris elected to take his Social Security income, his survivor benefit as early as possible and defer his PIA benefit because that would turn into a higher amount of income later on. And as a result, he's able to maximize total lifetime income. And so this strategy here shows that the reverse can be done as well. If when looking at your PIA benefit versus your survivor benefit, you can choose to take your PIA benefit early, in this case, as early as possible, age 62, and allow your survivor benefit to grow as much as possible until full retirement age. And so by waiting to elect the survivor benefit until full retirement age, the survivor benefit that they're receiving throughout the rest of their lifetime is $2,500, and they were still receiving their reduced PIA prior to that. So, that summarizes some strategies, some common strategies that we see in use and that we oftentimes use with our clients. In summarizing the webinar here today, we would really encourage you to not think about Social Security election in a vacuum. This decision should be made in conjunction with the rest of your plan, your income plan, your legacy plan, and really giving the time to make sure that you are making the right election decision for you can really help you maximize the amount of benefit that you ultimately receive throughout your lifetime. It can maximize the longevity of your plan and ultimately maximize the enjoyment that you can get out of your assets. So if you have any questions, we'd welcome a conversation with you. Feel free to call us here anytime, and we would be happy to help. But thank you again for attending tonight, and have a good rest of your night.